Good morning. It is Tuesday, June the 23rd. Here's what's on the agenda. Stocks drop as hyperscaler spending angst weighs on tech. We are on yen intervention watch after US-Japan FX talks. And with Burnham poised to be the UK PM, investors speculate on his pick for Chancellor.
OK, let's talk about this tech sell-off that we are watching around the world, Tom, and it is brutal out in Asia, in particular in Korea. The Kospi had a circuit breaker not that long ago. It's reopened. It is down by 8% this morning. It is pretty brutal. It gets a little less brutal, but still quite brutal if you think about the scale of the market when it comes to the Nasdaq. Nasdaq 100 futures are down by nearly 2% this morning. Keep an eye on that. And where does that take us? That takes us to Europe. Eurostoxx 50 futures, less tech, but still in effect. We are down 1% when it comes to what we are watching here in Europe. Keep an eye on the big names that we watch out of Europe. ASML is going to be interesting. Look at Nokia this morning. Look at these kinds of names to see what is going to happen when we get to that opening trade. We are going to start the countdown to it right now.
Welcome to the programme, everybody. It is Tuesday the 23rd of June, and we have an hour to go, just under, until we get to the start of the trading day. And let us put the focus squarely on what is happening in technology and a number of dynamics that are in focus. And Tom and Guy, you've both touched on this already, but the extent of the selling over in Korea, the place to start, I think, this morning. So down by 8%. We had that circuit breaker. The trading has resumed. There are specifics around ETFs tracking both SK Hynix and Samsung that are causing officials some concern there. And they're thinking about bringing in some stabilisation steps to limit the potential fallout from some of the really sharp swings that we've seen on the Kospi as a result of this. So that is one of the dynamics that we are watching. We are also watching, of course, Nasdaq futures weaker after the Nasdaq was down yesterday by more than 1%. And there we're seeing an interesting rotation story out of hyperscalers towards the semis because there is an understanding, a fear in some quarters that hyperscalers are spending so much money, and are they passing some of the benefits of this AI rollout onto the memory companies?
We have a chart that illustrates that gap, and it's like a crocodile mouth shape now in terms of the move higher for the SOX and the semiconductors index in the US versus the hyperscalers. Interestingly, that hasn't filtered across, obviously, to the Asian session, because you do have the chip companies that performed well in the US session yesterday. The likes of Micron, and we've got those earnings on Wednesday. Maybe Micron rise to the rescue. But that strong session for the chip makers in the US has obviously not been fed across to the Asian session. You're seeing the likes of SK Hynix and Samsung under a lot of pressure. Starts with debt. A lot of this is debt funded. Then, obviously, these hyperscalers spend a lot of money, and they spend it on the chips, and the cost of compute goes up. And the AI companies have then got to figure out what they do with that epic cost of compute. Can they pass it on to the final consumer, which sits at the other end of the story, to the debt story? Can they pass it on? And the answer appears to be no, because the cost of compute is epic, but the cost they're charging to businesses and everything else is significantly lower. There's a gap there somewhere. Where does the gap in that chain sit? Where does it break, and what happens when it does? Absolutely. So a lot of focus on the pricing and the ability to get back the revenues that these companies need if they're going to be doing all this investment. And meanwhile, the debt raising continues. We had at the back end of last week announcements about SpaceX raising debt capital. Well, now they are going to do it today. We understand that they are readying this first investment grade bond today. They want to raise $20 billion, which doesn't sound like a huge amount in the scale of everything that has been invested. But it's raised a lot of eyebrows because of the investment grade rating that this has been given by at least two of the ratings agencies. Yeah, the rating agencies seem to be pretty relaxed about the makeup and the fundamentals of this company as they go to the debt markets. And again, we'll see how well received it's been. The likes of Anthropic have raised, of course, Google have raised, and Google, in fact, Alphabet are raising in the debt markets, not Anthropic, and that's been well received. And so we'll see the same. But that is a very profitable company with a solid balance sheet. We'll see what the reaction is when SpaceX goes to the market with $20 billion. There is a fight on for debt, though, and it's beginning to emerge. Governments need you to invest in them. AI needs you to invest in them. Companies need... the fight is on, and it's going to be interesting to see who ultimately wins that fight. We're going to get PMI data today.
out of Europe, which I think is going to be really interesting in terms of what it's going to tell us about the data that is coming through and what it tells us about the European economy. Christine Lagarde yesterday, I thought, sounded quite dovish. The market's taken some weight out of the fact that we expect still further rate hikes to come through from the ECB. Do we still get one? Do we get none? Are we done? Was it one and done? I think it's going to be a question that I think the data today may help us with. But you get to the kind of the currency narrative. Lizzie was bringing us a chance in just the last few minutes talking about the fact that could the euro break if we start to see that dovishness beginning to increase. Currencies are on the move. You've got a really interesting story developing in Japan where you've got the currency at its weakest level potentially in 40 years. You've had an overnight conversation between the US and Japan. What happens with intervention? Oh, we're going to see it there. Back to Christine Lagarde. Real concern about what is happening in terms of the yuan exchange rate. She thinks that maybe actually that's part of the tools that the Chinese are using to push their goods into Europe. All of this coming together. Last week, Friedrich Merz talked about a Plaza Accord. That's back on the table again. These imbalances are beginning to get really interesting in the FX landscape.
And we have an economist with an FX background to talk to about some of these themes as we go through the programme. So that is interesting. And let's linger on the Japan story that you nodded to there, Guy, because the Finance Minister, Katayama, confirming that she'd had a conversation, had talked to Scott Bessent. There's an understanding, there's cooperation, there's alignment, all of those words coming out of that conversation. Is it still difficult to push against dollar strength for the Japanese? We are through, perhaps, the bulk of the dollar strength attached to the Iran war, but there are other reasons why the dollar has been strengthening, to do with the Fed and, of course, to do with AI.
And if Austin Goolsbee and his view and his concerns about inflation continue to be latched on by other members of the FOMC, that's a problem, arguably, for Japan. Further dollar strength, then maybe more increases in rates coming through for the Fed that, of course, turned hawkish, arguably, last week. Fed's Austin Goolsbee saying he's pretty concerned in terms of the direction of travel and really focused on services, the services prices as well, saying they are disturbing. So fairly kind of hawkish commentary from Austin Goolsbee. As we think about currencies, interesting that JP Morgan have come out and reiterated a bullish take on the pound. As investors now, it seems like by the end of yesterday, in terms of UK politics, the kind of consensus was, as we look at the different directions of travel and how the politics actually lines up, very difficult to see anyone other than Andy Burnham becoming Prime Minister, potentially as soon as July the 17th. So the focus then shifts to, OK, what does the cabinet look like? Do we get a general election? The Chancellor, it seems unlikely Rachel Reeves is going to be in place. Is it going to be a Wes Streeting? Certainly Gilts rallied when Wes Streeting kind of threw well, at least removed his hat from the ring and backed Andy Burnham. So the focus on the Chancellor, focus on of course, what the tax agenda is and whether or not we have to get a general election at some point this year.
I haven't mentioned Ed Miliband. Is
another name in the fray.
Is he still in the running?
Yeah.
Because that seems to be the fight now. Is it Ed Miliband, Yvette Cooper, possibly? Ed Miliband, Wes Streeting. How would the market react? Well, I think we're beginning to get an idea. Wes Streeting, good. Ed Miliband, not so
Yes,
good.
and Nomura, when Wes Streeting was in the running, had described him as a sort of more market-friendly candidate. Would that still apply if he were Chancellor? He, of course, says there's been no deal. I didn't back Andy Burnham to get Chancellor. I thought it was really interesting. We have not seen a transition of power away from Keir Starmer formally to anybody else, but you watched it moving yesterday, didn't you?
The
selfie in front of those Labour MPs, the fact that we had helicopters in the sky tracking his train as it came from the northwest down to London, tracking his taxi as it went from Euston Station to Westminster. I mean, that tells you a lot about what you need to know about where the power really lies now.
I think that's a given now. It is Burnham. But how much room for manoeuvre does he have? How much power? Okay, how much power does he have?
Yes. Whatever power exists, though, we were watching it transfer. Is that
it feels like it's a very small amount of power. Assuming that his ability, unless he significantly changes the rules, the fiscal rules, he has almost zero room for manoeuvre when it comes to the fiscal space that he's operating with. Sonia Martin from DZ Bank, call it what you will, is going to be joining us. She's now chief economist there. Matthew Amos, Aberdeen Investment Director, joining us, I think, from Scotland. Mark Dowding, RBC Blue Bay Asset Management Fixed Income CIO, is a great person to talk to. And Marco Argenti, Goldman Sachs Chief Information Officer, not CIO, Chief Information Officer, joining us a little bit later. But the perfect person, Tom, to talk to about this whole token cost, how much does AI cost story that we're trying to grapple with right now.
Yeah, the pushback against token maxing and what it means for the models, whether there's more of a focus on open source versus the frontier models and the closed source, and of course how jobs are adjusting across the world of finance. So a really good voice on that. Let's look ahead at what else we are thinking about through this Tuesday then. 9 a.m. UK time, we will get Euro area PMIs. 9:30 a.m. UK time, UK PMIs. 2:45 p.m. UK time, we're going to get US PMIs. So yes, a lot of macro data for you in terms of how we think about these economies. US earnings, FedEx aftermarket, Amazon Prime Day begins. Guy Johnson's getting his orders in. Amazon's annual deal event on June the 23rd to the 26th. Maybe new wellies for Guy Johnson.
Got those. Done that.
Kitted out
always
with wellies.
Always buy wellies in the summer.
Well,
but
I mean, but what season is this?
But
which season is this? I don't know whether to buy wellies
definitely summer.
or sunscreen.
It's definitely summer.
But you needed both in the last 24 hours, didn't you? Coming up on the programme, we will be watching the auto sector at the market open. This after European car sales grow for a fourth straight month, powered by EV and hybrid models. Plus, one of Europe's most important defence companies could announce plans for its IPO as soon as today. We'll get the details on that listing by KDNS later in the show. Up next, Andy Burnham is back in Westminster, but what would a new face in Downing Street mean for investors? We will break down the challenges ahead. If you have questions, if you want to get involved in any of these conversations, IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
I swear by Almighty God that I will be faithful and bear true allegiance to His Majesty King Charles, his heirs and successors, according to law. So help me God.
Andy Burnham there, the former Greater Manchester Mayor, returning to Parliament yesterday. He appears set to become the UK's seventh Prime Minister in a decade. Burnham's path to number 10 Downing Street was cleared yesterday when Keir Starmer announced he would step aside as leader of the Labour Party, and the most likely other contender stepped aside. Let's bring in Bloomberg Daybreak anchor Lizzie Burden, and who's obviously been following this for us. And I'll just say that at the other end of that clip, you know where I'm going with this, the other end of that clip, somebody heckled, he's not the Messiah, and Andy Burnham shouted out naughty boy, which is a quote from Life of Brian. And I suppose the contrast on day one with the style of somebody like Keir Starmer and the style of somebody like Andy Burnham was very evident and very clear to see. That's not policy. That's not a change you can pin down. That doesn't tell you anything about fiscal rules. But I just thought it was really interesting to see on the first day.
Yeah, and vibes matter. Do you remember when Starmer and Rachel Reeves came in and they were talking about the economy? They talked down the economy, and that doom and gloom weighed on the economic data. So a bit of vibes might be welcome in UK politics. And I was metres away from Starmer when he was resigning yesterday. And when you listened to that speech, he struggled even to articulate a vision of what his achievements had been.
They've been other people's achievements, basically, as far as I could tell.
And yet they were not credited in that speech, which just speaks to the reason why that premiership failed so fast.
OK, so he's got the style. Does he have the substance, Burnham?
Well, we'll have to see how far vibes can take him. We're going to see more details coming out because there's going to be a vacuum, right? If there are no other candidates to challenge Burnham, then all of the media attention in the UK is going to be hounding him for details on what's your policy and who's in your team. And at the moment, it looks like because Wes Streeting, the former Health Secretary, stepped aside and backed Burnham, no one else is really going to have the numbers to challenge him. And actually, Burnham might not like that. He might have liked to have the summer to set out his policy agenda, to think about what he's actually going to do.
Please tell me he's already done that.
Well, you would hope. all those
we
years
hoped that in 2024, didn't we?
But this could have been the parting shot of revenge from Starmer to Burnham, to the guy who basically ousted him.
Yep. We will watch. Lizzie will watch very carefully. Burden on Burnham. Thank you very much indeed. Joining us now, Sonia Martin, Chief Economist at DZ Bank. Sonia, good morning. You are watching British politics from afar. Do you buy or sell the pound on what you've seen thus far?
I think I'd rather sell in the short term. There's so much uncertainty. Andy Burnham is not tested. The fact that he doesn't have to go through a leadership contest is already being criticised as raising potential problems later on. There's a comparison being made to Theresa May, sort of sailing through to premiership and then, having to deal with a bunch of issues. So we'll see how he does. But ultimately, I think we can all agree that he's going to inherit the same problems that Keir Starmer had to deal with. And there are really no easy answers to those problems.
Isn't the easy answer just to change the fiscal rules?
Well, I think that's definitely a risky move to make, given the focus that there is on fiscal policy already and the experience that the UK has had. So I think they'll have to take a really long, hard look at the situation and come up with some credible answers and, revive the economy, revive the labour market. There are a lot of issues on the table, including apparently a look back towards Europe. So that's going to be interesting.
Yes, I wonder what the take is over where you are, Sonia, on that kind of theme. I mean, we don't know much about what Andy Burnham as a potential Prime Minister would be about, but we know that Wes Streeting stepped aside and described the differences as small, and he is somebody who's definitely talked about a much closer and possibly one day going back into the EU. He's talked about a whole host of different tax changes as well. So there is a policy vacuum. We don't know where this goes, but on Europe, what difference would that make for the pound?
Well, I mean, I think there's wide agreement now that Brexit was considerably damaging to the UK economy. Maybe not in the immediate effect that some people had predicted, but I mean, there are many studies now that have really confirmed that it was, for the UK in many ways, the wrong move. So looking back towards Europe makes sense, but it's of course a very difficult move given that Nigel Farage is sitting on the sidelines hoping to become Prime Minister in the next general election. So any move towards Europe is going to have to be very careful. And of course, from a European point of view, while I think in many ways we would like to welcome the UK back into the embrace, there's going to be some concern that this may not last depending on how the general election next time goes. So I think any discussions that we're going to have there are going to be quite difficult and fraught with potential problems.
Yes, I suppose it's worth noting, Sonia, that question was to mark the 10-year anniversary since the vote. Tomorrow, of course, the 10-year anniversary since the results, but the vote. Let's move on to Japan. That said, let's move on to Japan, because there we've had some overnight news surrounding the yen, or at least conversations between the Treasury Secretary in the States and the Finance Minister in Japan. Are you expecting further intervention, Sonia, in the yen? And will it be easier if the war in Iran is in the rear-view mirror to some degree, at least in the short term?
Hi, can I ask, can you still see me?
Yes, we can. Yes.
But you appear to be not moving.
No, because my computer screen just gone blank. I don't know what's happened here.
OK, well, do you want to give us the answer? What are your thoughts on the yen?
I'll try.
See what we can do about the picture, Sonia.
Okay. So as far as the yen is concerned, I mean, obviously we're pushing to levels that we haven't seen in a very, very long time. The MOF and the BOJ are going to be massively concerned about this. There is a high chance of more intervention anyway. But the problem with intervention we've seen before is that it doesn't really have a lasting impact. So what we're seeing is some movements in the short term, and then investors just jump back on the strong dollar trend. So I think there isn't really an easy answer to that issue of the weak yen.
Sonia, is it for the BOJ and for the yen, in fact, any intervention either without the BOJ hiking or without the Fed turning a little bit more dovish, which seems unlikely given the hawkish tilt last week, that any intervention will be short-lived then in terms of the impact, in terms of potential yen strength on the back of that move?
Yes, absolutely. I think that, and the BOJ is hiking. I mean, that's not, in a sense, not really the problem. I mean, the BOJ is doing what it's meant to be doing. I think the problem is always a little bit that the BOJ has a tendency to garnish its rate hikes with some fairly dovish language and very cautious language, and that I think often results in the yen failing to really take much of a boost from those rate hikes. And yes, as you said, there's the contrast. You know, the Fed quite hawkish these days. We'll see how that plays out. I'm not necessarily convinced they'll hike, but yeah, that's all leading to more dollar yen strength, and there's a strong speculative element in there as well, of course.
So we have Eurozone PMIs. I'm going to switch from Japan to Europe. We have Eurozone PMIs out later this morning. Does Europe need a weaker euro at this point?
No, I don't think that a weaker euro is the answer to our issues. I mean, sure. I mean, when we look at Germany, the export sector has been suffering from tariffs imposed by Donald Trump. We have an issue in that we are exporting a lot less to China, whereas we're importing a lot from China. So there is a trade issue there, an export issue there. I don't think a weaker euro is the answer to that issue. I mean, where we are right now, the euro is far from being overvalued. I think that's not the solution. I think we definitely don't want a very strong euro. I can agree with that. But I think a much weaker euro, while good for the export sector in theory at least, also comes with some side effects. You know, we'll have to import a lot of goods at a higher cost. So it's not like that's going to resolve the issue.
Sonia, why don't you think the Fed's going to hike?
Well, I mean, yes, he was hawkish. The Fed was hawkish, definitely. But when we look at the labor market, I think the robustness that the recent data seems to suggest is superficial. When you look at the data that's underlying the ISM, when you look at how willing companies are to hire, open jobs, etc., you see that the labor market, while far from very weak, is certainly not as stellar as maybe some people had interpreted after those numbers. So I think the labor market isn't that strong, and the inflation is going to come down prospectively. So I think the Fed has no cause to hike rates. The language, the hawkish language, sure, I can understand, and maybe it was a signal, to the White House as well that they'll do what they want to do. But I think ultimately they won't have to hike rates this year.
Okay, Sonia Martin, Chief Economist at DZ Bank. Thank you very much indeed.
OK, let's move on and figure out what else we need to know this Tuesday, the 23rd of June. Apollo is once again limiting withdrawal requests from its largest non-traded private credit fund for retail investors. Apollo Debt Solutions, which has roughly $25 billion in assets, capped withdrawals at 5% of outstanding shares Monday. The move came after investors asked to redeem nearly 17% of the fund. Oracle has reduced its workforce by 21,000 employees over the last 12 months, a bigger number than previously known. A regulatory filing reveals global headcount shrank to 141,000 full-time staff, and the company says the adoption and deployment of AI may continue to lead to further job losses. And European car sales grew for a fourth straight month in May as consumers snapped up more affordable electric and hybrid models. EV demand is getting a boost from high fuel prices, with the conflict in the Middle East choking parts of the global oil supply story. Sales have been helped by more affordable models from manufacturers such as Volkswagen, Stellantis, as well as Chinese brands led by BYD. And in some ways, this takes us back to the Chinese story. Legarde's getting concerned about the weaker currency. Obviously, you are seeing the Chinese government. There's a great story on the Bloomberg Terminal talking about this morning, not pushing consumer demand in China, in fact, going in the opposite direction with the fiscal policy. And therefore, they're pushing exports out to places like Europe.
Yeah, there's been a lot of anger in parts of Europe around that absolute same thing. And a really great piece over the weekend about the car industry and the changing nature of the car industry in Europe, and how, not everywhere at all, but it just in pockets now, we're starting to see it just become a contract manufacturer for Chinese car companies, as we've talked to Chinese companies about. Yeah,
and we're seeing in the data, the EV numbers in terms of Germany, for example, an increase of more than 30% in terms of EV sales, offsetting what was essentially flat in terms of the traditional engines, combustion engines, and a big part of that is coming through from the Chinese brands, because if you want cheap electric vehicles that have some tech in them, then Chinese brands are competing quite strongly. So they continue to build out that market share. That's what the data is showing.
And if you're a European car company, do you try and compete against that, or do you try and play along with it and provide services to those Chinese manufacturers? That's the car story. We'll continue to watch what's happening there. Shall we have a moment to reflect on what's going on with the tech story once again, because Nasdaq futures are now down by more than 2%. So setting us up for not drawing a line in the sand after yesterday's selling, effectively another day of negativity on the tech story.
It's not clear what exactly the catalyst is at this point. It's the spend questions around
making
the hyperscalers.
Space for SpaceX debt raises, issuance. At the margin, one thing.
I'm always slightly wary of sort of tagging narratives onto story. Is the SpaceX debt story the reason for the SpaceX sell-off, or is the epic rally that we saw in SpaceX stock the reason for the retreat? I don't know.
Well, we're going to get back to the macro after the break, because coming up, as the ECB president says, the bank doesn't need to react forcefully to the Iran war. We're going to talk markets with Matthew Amos from Aberdeen Investment Management. That is next. This is Bloomberg.
30 minutes to go. The equity market's going to be interesting this morning, isn't it? There are dips and then there are dips. The Kospi is certainly having one of those dips this morning, down circa 8%. It's a big move lower. US futures are moving sharply to the downside as well. Europe, in some ways, protected, but not completely. We are likely to see some of the big tech names here in Europe come under pressure. We certainly are seeing that in the rest of the world. The 50's down by 1.25. The FTSE's down by 1.1. The CAC's only down by 0.8%, but yesterday had a very tough day when it came to the luxury names. What's happening in the bonds?
Yeah, absolutely. The luxury focus was on the market, on the equities yesterday. Let's talk about bonds, and we've talked a bit about how they don't necessarily provide the same kind of haven when you're seeing stocks selling, but we are seeing a bit of bond buying at least today, but maybe not for those reasons. We are seeing some bond buying across Europe, but very small moves, just 1-2 basis points really at the 10-year horizon.
Yes, we did see that rally, didn't we, certainly in German debt yesterday, on the back of the comments from ECB President Christine Lagarde, who says the central bank does not need to act aggressively in response to the Iran war. Speaking to lawmakers, Lagarde expressed confidence that inflation will still return to target.
The shock is too large to look through without jeopardizing our target. But we see no evidence yet of de-anchoring of inflation expectations or second-round effects that would warrant a more forceful policy response at this stage.
Well, Matthew Amos, Investment Director at Aberdeen Investment Management, joins us now. Matthew, do you get the sense that this is a dovish kind of tilt from the head of the ECB? Do you see opportunities in sovereign European debt if this is an ECB that's turning at least a little less hawkish?
Yes, I think so. I think obviously we had the hike 2 weeks ago from the ECB, and I think that was largely factored on where we were with Iran, where the Straits of Hormuz were, where the price of oil is. If we see the continuation of the kind of de-escalation in geopolitics, which we all hope we do, and the oil price continues to move lower, then the ECB have the ability to kind of sit on their hands here. So from our perspective, we kind of look at front ends across Europe, including the UK, and we think too much is priced in here. Obviously, that is caveated massively on what happens in the geopolitics. But yeah, I think there's an opportunity across the piece in Europe here.
OK, opportunities at the front end, and you mentioned gilts. You like gilts. You would be buying gilts at this point.
Yeah, absolutely. Of all the central banks which we think is mispriced, the Bank of England for us is number one. We look at the kind of where we started in terms of restrictive policy. The Bank of England think they're restrictive. They still think they're restrictive, even with inflation expected to go higher. We look at the statements from the various different Bank of England members last week, and from our perspective, two members might have voted for a hike last week. But if we look at the detail of the other members, the people we need to vote for a hike, they seem to us to be pretty dovish. I think from our perspective, as long as oil continues to go lower, then we think that the Bank of England can be very comfortable sitting on the hands for the rest of the year and potentially go back to rate cuts in 2027. The disinflationary kind of trends that we saw pre-Iran still going through. We see that in the inflation data, and crucially, we're not seeing any, as with Euro, as with Madame Lagarde said yesterday, we're not seeing any second round effects. We're not seeing any pickup in inflation because of the move higher in oil. And if that continues, again with the right politics, again we can talk about politics after, but the right politics, then I think gilts are a good buy here, especially at the front end of the curve. Those kind of less than 5-year gilts look attractive to us here.
That's interesting. So, Matthew, you talked there about the reasons you're positive on gilts, and yes, I will come to politics in a moment, but is it very much a Bank of England story for you, actually, the gilt market? Do we focus too much on the politics?
I think if you look at the kind of the shifts, the large underperformance in gilts, obviously we've had volatility over the last 5 years. But when it's been politics, it's gone in and then the gilt yields come back. If you look at Liz Truss, the yields went higher and then they came lower because politics can change direction on the politicians are prone to a U-turn. The things that the gilt market can't react to, and the things that policymakers can't react to, is when we have inflation. Inflation takes a long time to get in the system and get out in the system. We're still kind of not quite recovered from the impact of 2022. So as long as we don't have that inflationary impact from this conflict, which we don't think we are, then yeah, I think we need to focus on the Bank of England, and that should drive gilt yields lower.
Yeah, and you said with the right politics, what message would you have about the right kind of politics right now that would keep volatility muted in gilts?
I think so far Burnham has obviously got off on the wrong foot this time last year with his various comments about in hock to the gilt market, but we've got past that. He has confirmed, or his people have confirmed, that he's going to stick to the fiscal rules, which I think puts a lot of people's fears to the kind of the back shelf for the time being. The idea of when Andy Burnham was talked about at the start of the year, we were talking about nationalisation, the idea of big gilt issuance to bring private sectors back in house. I think we've moved past that. The fiscal rules are key. He probably could amend the fiscal rules if he wanted to, but I think the fact that he's confirmed the fiscal rules should buy him some time over the summer before he becomes Prime Minister.
If Ed Miliband was Chancellor, would you continue with that view?
I think Ed Miliband probably wouldn't be the gilt market's first choice of Chancellor, but it's all about the rhetoric that he comes to when he comes to the job. If reports are true, it was Ed Miliband who was advising Burnham to weigh down on the fiscal rules, to stick to the fiscal rules, to get out and to talk to people, to say that the fiscal rules are key. Yeah. So I think, Miliband, the proof in the pudding is going to be in the eating. So we'll wait to hear what Miliband has to say.
Matthew, you are basing this, it seems, all on the idea that he is going to stick to these rules. How far can he stray from these rules before there are problems?
Yeah, so I think the fiscal rules, every Chancellor rewrites the fiscal rules. The fiscal rules have been rewritten more times than we've had Chancellors in the last few years. So the fiscal rules are key at this moment because it gives the investors some confidence. But if the new Chancellor and Burnham wanted to change the fiscal rules, then I think he has the ability to do that. But he has to do that from a position of strength. He has to do that from winning the gilt market over. So if for example, he wanted more money to invest, long-term investment, I think that would be acceptable for the gilt market. But that has to be that on the other side of that, we have to see a kind of Chancellor that's willing to make some tough decisions when it comes to spending, kind of day-to-day spending. So there's some big ticket items which weigh heavy on the kind of the UK. If we have a Chancellor who on an anti-Burnham, someone who is willing to kind of look at those issues, tackle those issues, then that will buy him some kind of grace at the back end to increase, to spend more, to create some kind of growth policy in the UK.
So Matthew, just to be clear, the gilt markets, you think gilt market investors would be relatively comfortable with an Andy Burnham and whoever the Chancellor is expanding spending if it's carved out on capex, things like defence. That would be the gilt markets and investors would be okay with that.
I think that if that's offset with day-to-day spending cuts, I think we've kind of dodged some of the big decisions in the UK over the last couple of years. Numerous chancellors have dodged the ability. So I'm kind of thinking about the benefit system last year. The Labour Party had a go at amending that, but we failed that. We kind of look at a kind of pension structure, things along those lines. If we're willing to kind of tackle some of the big decisions, some of the day-to-day spending, to reduce the day spending, so the kind of the fiscal rule that we talk about a lot, then I think that would buy some grace to kind of to amend the debt rule that Reeves created to allow greater spending to kind of to allow investment, to allow growth in the UK.
Matthew, thank you so much. Thanks for joining us. Matthew Amis, Investment Director at Aberdeen Investment Management. 7:39 here in London. Coming up on the programme, crude extends declines after the US allows Iran to sell its oil on the international market. We will get the latest from the Middle East next. This is Bloomberg.
we're doing very well with respect to the Hormuz Strait. We took in more oil yesterday than has ever gone through the strait. You probably see that we have an oil gusher. The strait is totally open. You know that, and we're negotiating. We'll see how that all goes. But we have two things: we have an open strait, and we have a country that will never have a nuclear weapon. Will never, ever have a nuclear weapon.
President Trump speaking at the White House late yesterday. The president, of course, speaking a few hours after the US issued a 60-day license, a waiver, allowing Iran to sell oil on the international market in dollars. The move gives Tehran an economic lifeline as the two sides continue talks for a permanent peace deal. The technical talks, I think, have ended today, but we will get more of them coming. Joining us now is Bloomberg's Abir Abu Omar, joining us from Dubai. This waiver seems really significant, and it tells us a lot about what is happening in these markets. Is the fact that Iran is able to empty its tanks, deliver oil, particularly to Asia, going to keep these talks on track?
Good morning, Guy. Well, yeah, certainly. I mean, what we've seen after the Treasury waived its sanctions on Iranian oil sales, those oil sales, by the way, are primarily crude that was blocked in the Strait of Hormuz due to the U.S. naval blockade and some exports from Kharg Island, which is Iran's main export hub. So our teams have been tracking what has been going on in the Strait of Hormuz, and there's about 30 million barrels of those crude exports that have made their way to Asia. So that's much needed supply, Guy, that has been quite stifled over the past 2-3 months due to the shutdown of the Strait of Hormuz, or the double blockade of the Strait of Hormuz by both the Iranians and the United States. And over the weekend, Saturday and Sunday, our teams have also tracked about 8 million barrels that have been making their way through the Strait of Hormuz. Now that still compares to about 20 million barrels per day pre-war. So we're seeing a movement in the Strait of Hormuz, or as President Trump has said, oil is gushing through the Strait of Hormuz a little bit more than what we've been seeing over the past few days or so. So positive movement. Now, just one thing to keep in mind, a few caveats, if you were, is that those 30 million barrels, the rate of that movement will probably go down because, as I mentioned, those are blockaded barrels that once we're done and dusted with those, will go back to rates seen before the war. And even before the war, 2 million barrels a day for Iran was already high numbers over the past few years. So that, again, good movement in the Strait of Hormuz, what President Trump had wanted in terms of the biggest concession. But when it comes to the state of the talks, and you did mention technical talks, we're set to end today. We know that the high-level negotiators, that's Vice President J.D. Vance and Ghalibaf, the Iranian parliament speaker, are set to go back home, while lower-level negotiators remain in Switzerland for the remainder of the week to negotiate some other concessions. But, Guy, we've been seeing back and forth yet again in this MOU discussion. One primary thing is Vice President Vance did say that that the sides had gone into discussing nuclear abilities in Iran. The Iranian side came out and said, actually, no, that hasn't been the case. Vice President Vance also suggested that the blocked frozen assets that were unblocked by the United States will be used by Iran to buy U.S. agricultural products. Iran has not confirmed that. And then the main sticking issue remains Lebanon and Israel's hostilities on the southern part of Lebanon and Hezbollah's hostilities on the northern part of Israel. Those remain key issues. Now, the situation in southern Lebanon has been a little bit more muted over the past couple of days, but the aggression there still remains. And so it's still unclear what exactly will happen to the Lebanon clause in the MOU, but definitely some conversations going to the direction of trying to end it and reopen the Strait of Hormuz fully, and then continue those negotiations into the next 60 days or so.
Yeah, meanwhile, we have a $76 handle on Brent. We haven't seen those kind of prices since the end of February, beginning of March. Abir, thank you very much. Abir Abu Omar with the latest there from Dubai. Let's broaden the focus and talk about the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. And Mark, we have to start with tech selling over in the Asia session, down at one point by 10%, in fact, closing just shy of 10% lower on the Kospi. Some people putting a lot of focus on the role of ETFs in the Korean market, some pointing to newspaper reporting around one particular company maybe moving more to DRAM away from HBM. What does that tell us about AI? What's catching your attention in the tech sell-off in Asia?
Yeah, there are a host of potential inputs, and we know that the backdrop of retail enthusiasm or euphoria for the Korean stock market has been extreme for some time. So it's been ripe for some painful volatility. I think what's really notable today for someone who was kind of watching it live was this is the first session in Korean stocks in more than a year that I remember where the bounces were so tepid. So even in other large sell-offs that we've seen over the past year, because we've had a couple of other large sell-offs, we've had very volatile price action. So it would sink and then it would suddenly bounce 4%, and then it would go back down and then suddenly bounce another few percent and back down. Today, we really just were not getting any kind of bounces at all. It just seems like there was no ammo to buy the dip. And that was a real notable change in price action that made it seem quite bleak. And that's why I think that there's more to go in this.
Yeah. Okay. We see margin calls, obviously they tend to come through later. In terms of the backdrop to this, how extreme is the leverage situation in this market? If it gets going, how much more juice, as you say, could there be?
I mean, a lot. Look, we know we've got an AI capex bubble. We know that we've got a bunch of stock markets that are leveraged play on that. And we know that there's massive retail participation and there's a lot of leverage. And therefore, these losses can snowball on the downside and then they can feed into the real economy. Is this the bubble blowing up? That's way too big a call to make. I would say that, as you guys know, I've headed this market since mid-May. I think we are in the end game. But as we've discussed a lot, the end game can normally last several months and involves lots of really volatile periods. It's about a higher volatility phase. So I could see this being an extreme sell-off that lasts for maybe a week or a few days, whatever it is, and we could see 15, 20% drawdowns. But it won't necessarily be the end of the bubble, because I just think we're in that volatile final stage. I'm open to the idea of being the end of the bubble, but I wouldn't be convinced yet.
Is there support, Mark, that maybe comes through from central banks? I mean, yields are down, oil is down again. Maybe we're getting a dovish tilt at the ECB. Maybe the BOE can stand pat. Maybe it looks to cut in 2027. Is that where the support comes through, maybe in the months ahead?
I think it's too marginal. I think that's ultimately correct, that we might have seen the end of the kind of inflationary impulse from the war, assuming that deal continues to hold and talks proceed, which looks very likely. There seems extreme determination from the US side to keep this kind of peace going. So therefore, I think there will be some relief on the yield side, but I'm not sure it's sufficient. Maybe that provides enough for people to have another reason to buy the dip and we get one more big leg up in the bubble.
Yeah, for now, that dip is not being bought, to your point. Bloomberg Markets Live Executive Editor Mark Cudmore, thank you, of course. Remember, you can up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get your stocks to watch this Tuesday and bring in Charlie Wells standing by. Charlie, you're starting with autos.
Yes, I am, Tom, and that is on the back of that news that we have this morning that European auto sales increased for the fourth consecutive month. Now, this could give a potential lift to the sector that has been struggling in the past couple weeks, because last week we got a warning from BMW about potential softness out of China that really hit the sector. So these sales in Europe could help in this market. And what we know is that EVs have actually been giving a lift to this sector. The sales were up, particularly in Germany. So again, that is on the back of some of this oil price pressure that consumers have been facing. But look into the numbers from some of these European auto sale figures, because what we've actually seen in the numbers this morning is that BMW and Mercedes saw growth from the same period last year, whereas Stellantis and Volkswagen actually saw decline. So look for a little bit of divergence at market open in just a few minutes. Let's flip and take a look at Hermes, because this really speaks to a broader story about luxury. Hermes had a bad day yesterday. Their shares dipped some 6.2% at one point. You can see that dip there. Now, that is related to two separate analysts warning about profitability ahead of their earnings next month. So again, we've also got this morning HSBC downgrading Hermes. So this is one to watch. Do they head in the same direction or not? And we see some of this analyst commentary talking about how they were maybe a little bit premature on analysis of Hormuz. In January, of course, we did not see a lot of the geopolitical tensions coming at that point. And the key question for the luxury sector really is, if that conflict in Iran wraps up, do we see a recovery for the likes of Hormuz, for the likes of its competitors, or are there structural problems that continue? That's really what a lot of investors are reckoning with right now and in the weeks ahead. Let's end on Selloff, because they had a really bad day yesterday too. Their shares were down actually to a 6-year low. I want to bring that up because you can just see them really down, struggling there. That again is related to AbbVie, one of their competitors, buying a firm that could actually eat into the drug pipeline for Selloff, particularly one of their blockbuster drugs. Now again, we've got news this morning from Selloff that the EU has approved a treatment from Selloff for multiple sclerosis. Do we see dip buying? Do we see a little bit of upward movement on the back of that EU approval? That's a really big question as we head into open.
Charlie, thank you. Bloomberg's Charlie Wells, of course, with some of the individual stocks we're focused on. If we take a step back and look at some of the sectors that could be in focus, it does look as if it's shaping up to be a bit of a tough day for Europe. Of course, the inputs from Asia look tough, but sometimes that really cross into tech is not all that pronounced. But we do see DAX futures down quite substantially, down by more than 1%. AEX futures down by more than 1%. And we also have a weaker oil price, which means that London won't necessarily provide any counter, and FTSE futures are also under pressure this morning.
At an index level, do you just sell at this point? It's kind of a lot of this selling will be sort of program trading at that kind of upper level. Single stocks, it's going to be interesting to see how it feeds through and how personal it gets, almost kind of on the individual.
Well, do you
stock
do that?
level.
Do you do that before Micron earnings come through?
Yeah, that's an interesting point.
And PCE as well, of course, on Thursday. I think that's when the PCE data comes through. Micron at the end of the day on Wednesday. But currently, the European tech sector looks to be set for a challenging day after, a 10% drop right now over in Korea.
And how much of this is fundamentals around the AI trade, and how much of this is the functioning of ETFs in Korea having a kind of ripple effect into global markets? We'll pick up with that theme. We will bring you the opening trade here in Europe. Futures pointing lower. This is Bloomberg.
Okay, here we go. We're a couple of minutes away from the opening trade here in Europe. This was yesterday's session over in the United States. We drop early and then we go sideways. This morning, though, you look at what's happening with futures and they are still and increasingly negative. And that tells you that the dip is not being bought. This has legs. Potentially this is being driven by something out of the States, so it's definitely being driven by something out of Asia as well. But the combination of the two points to a negative picture, Tom, here in Europe.
So brace for that sell-off then, with European stocks 50 futures pointing lower by 1.2% right now. We focus, of course, on the tech story, but also maybe the miners as well, given what we're seeing in terms of selling coming through for the likes of silver and copper and gold as well. FTSE 100 futures then, in that context, pointing lower by 107 points, a full 1%. DAX futures looking to drop 300 points, currently pointing lower by 1.2%. The handoff from Asia, to your point, Guy, has not been pretty. Anna, what are you looking at?
Yeah, well, let's pick up with that thought, because we could see some negativity around the tech names here in Europe as a result of that heavy selling on the Kospi, down by 10% towards the end of the trading day over in South Korea. So what kind of impact will that have? And plus, of course, the rotation trade that we saw yesterday out of hyperscalers into semis over in the US. So a couple of themes going on there. What does that mean for European tech stocks? We'll watch the AEX, we'll watch the DAX. Oil stocks in focus as well, as oil prices are weaker. Signs of tentative progress, that Iran waiver signalling peace talks, making some progress, signalling also more energy into international markets. And so the oil price is down by 1.4%, 76 the handle on Brent. And autos in focus then, guys. We've had European car sales. Growth has slowed as inflation pressures have been mounting, but maybe that's the story in the rearview mirror.
Got a lot to fold in this morning, haven't we? Let's talk about what we're going to see. Let's give you some numbers, give you an idea of what is actually happening. Are the futures telling us the right picture, giving us the right picture? Let's show you what is happening. So the FTSE 100 expected to drop this morning. Got an oil price story. You don't have much tech, but you've got a narrative around the world of equities under pressure, which I think is an interesting one. So the FTSE 100 just beginning to drop a little bit. The Stock 600 is already down by 0.5%. We're looking for more than 1% or around 1% in terms of the drop that we are going to see across these European markets. Yesterday, the CAC was under pressure as a result of a big drop in Hermes. Today, you could see Remy under pressure. It's going to be interesting to see how that story develops as well. The CAC is down by 0.8%. But look at the AEX. We're down by 1.25%. How much of that is ASML? How much of that relates to this chip story, Tom, that we are seeing out of Asia?
ASML is currently down a little over 4%. So amongst the biggest laggards across your sectors, technology, as we expected. So tech as a sector amongst the biggest losers, down 2%. And ASML is certainly playing that part on the downside with that loss of 4% right now. Basic resources also taking a big hit. That sector is the biggest loser. 2.7%, 2.8%, so almost a 3% drop for basic resources. Again, we've been seeing that pressure coming through, particularly in terms of silver, gold, copper and iron ore as well. The three sectors that remain in positive territory: personal care up 0.3%, food and beverage up 0.2%, healthcare up 0.2%, slightly defensive tilt then. Just three sectors so far in positive territory. The biggest losses coming through for basic resources, tech and autos.
Yes, the basic resource trade quite substantially lower, down by 4.6% on the likes of Antofagasta, down by nearly, 3.8% on Anglo-American. In terms of the individual movers then, we'll pull up some of those, take a look where we are there. Yeah, defensive flavour to the upside with British American Tobacco and Sanofi, the two that have popped up on that board. There's the tech sell-off in the shape of ASML, linked to Schneider Electric via AI as well. And then there's the basic resources story for you. And interestingly, another day of negativity, and apologies if you mentioned this already, Tom, another day of negativity on the luxury story with Hermes, down by 2.7% in this morning's session then, Guy.
Yeah, it's fascinating. SML is easily the biggest points drop by a mile on the Stock 600, down by 1.2 points in terms of the drop that we are seeing. So, yeah, we're seeing significant loss. It's a really obvious trade this morning, isn't it? You head for the defensives, you head for the pharma stocks, you head for the food producers. All these kinds of names are doing relatively well, and you get out of banks, it seems. Banks are under a little bit of pressure, but as you say, it's the resources story, but mainly it's the tech story this morning. Yeah, mainly it is the tech story. So let's start there in our conversation with Mark Dowding, fixed income CIO at RBC Blue Bay Asset Management. So with your fixed income lens, Mark, I wonder what this tech selling means to you. There are so many themes going on here. There's a lot of volatility created by ETFs in Korea on single name stocks. There's a focus on the Hynix product mix, which is being attributed for some of the selling over in South Korea. There's rotation within the US tech trade. I don't know what if any of that matters to you. What are you watching from your perspective from this sector?
Yeah, look, if you stand back a little bit, I think what you would say is that some of the recent performance in stocks has been highly speculative, fueled by a passion from retail investors for short-term gains, looking at momentum. This is the way that markets have been behaving and operating. And you see that, I guess, writ large in something like the behaviour of the SpaceX IPO and the big move up and the correction back down again. And this is what we're seeing in terms of market behaviour. But the one thing that I would say as a fixed income investor standing back from this just a little bit now would be it's not fashionable to remind retail investors of this, but actually stocks with very high multiples, very high PEs are long duration assets, and long duration assets are going to be sensitive to changes in the long-term discount rate that we see coming through from the bond market. So where you do end up with bond yields moving higher, where you do see those discounts rates moving higher, inevitably this is something that should weigh on the valuation of stock markets. It should actually cause financial conditions to tighten somewhat. This is effectively how monetary policy is meant to work, and we can't just be going to the party, going crazy all summer, sending the S&P to 10,000, can we?
So this is good for us?
I think it's healthy long term, yes. We may not like it this morning, but actually it's healthy behaviour, because you don't want to have a build-up of speculative pressures run ahead of itself too much, because then if prices do run up too high, then the correction back down to earth will be more painful as and when it comes. So from an economic point of view, steady as she goes is always better than this crazy behaviour that we've been seeing in the course of the last few weeks.
Mark, can I just show you a chart? I want to bring up dollar yen. We're getting a move this morning. You can probably see it here on my screen. Would it be surprising to see the Japanese in the market this morning?
In many respects, no. I think ultimately the Japanese authorities are under pressure here. Ultimately, the story on dollar-yen at the beginning of the year was that the yen's a very undervalued currency, but there was a hope that actually Japanese interest rates would be gradually moving higher as interest rates elsewhere in the world were moving gradually lower. But that's not now the backdrop. You now have a case that you have this gradual normalisation in Japan, but other rates elsewhere are moving upwards as well. So that rate differential is not closing, and without that closing you continue to see pressure on the yen, and intervention can hold it to a point, but clearly north of 160 we've been in this intervention zone. There was a meeting yesterday with Besant and the Katayama, the Japanese Ministry of Finance official, speaking to the idea of intervention. So they probably need to do something, would be the message from the markets. Whether this is actually intervention that we're seeing this morning, right here, right now, it's more maybe the threat, the idea of intervention that's got markets guessing, but we're certainly in that zone here and now.
Right here, right now, to quote Fatboy Slim. Thank you for that. Do we just repeat this cycle then? So they intervened in April. They may intervene again now, the financial authorities, the finance ministry in Japan. Until that rate differential closes, do we just get a repeat of this? Because the kind of consensus view is that intervention is only works for a short period of time until that changes. Is that what we see now for weeks and months ahead, until that dynamic changes, until the rate differential closes?
I think effectively so. Either you see the Japanese authorities agree to actually accelerate the pace of monetary policy normalisation, but that doesn't seem likely because Prime Minister Takeichi wants to run a dovish monetary policy stance, and so is in no inclination to actually hurry up. But the one thing that's interesting here is if the yen starts sliding again, that's really going to hit Takeichi's popularity. And if it hurts her popularity, her position within the LDP will be weakened, and she can't afford this to occur. So she may end up becoming persuaded that the BOJ should be allowed to normalise rights more quickly, but that may happen only after we see another bout of yen weakness. So from that point of view, whereas earlier in the year we thought that the yen had good asymmetry, you should be buying the yen north of 160, betting on that intervention. Here and now today, I think it's anyone's choice, and I'd rather not be playing in the yen just at the moment.
OK, so not playing in the yen just at the moment. What about gilt markets? Are you interested in buying gilts? The yields have actually come down in the last few. Well, actually, no, yesterday and today. Today, the gilt opened down 3 basis points at the 10-year horizon. Friday looked different. We saw yields across Europe going a little bit higher. And last week, in fact, we were pricing in the more hawkish Fed. So things looked a little bit different. So what's the gilt view at this point?
So, on the one hand, I'd actually say that the valuation in gilts looks interesting, and certainly at the front end of the curve, you're pricing a couple of rate hikes in the context of the UK, and against a weak economic backdrop, those rate hikes may end up not being delivered. So, from a valuation point of view, I think gilt looks interesting. The problem that we have is the politics, and we need to remind ourselves that the reason that Starmer is out, Burnham is coming in, is because there's a desire to change policy. That desire to change means more investment, it means more spending, it means more taxation, and I think we're kidding ourselves if we think that we're going to end up with Wes Streeting in as Chancellor and nothing's going to change, and therefore the bond markets don't need to worry, because you wouldn't be sort of changing tack with PM in the first place if the status quo was what the party wanted. I actually think that you're going to see more decisive break to the left. I do think that there'll be a desire to tweak the fiscal rules, to do other things to move money off balance sheet. And I think that bond market at some point may end up testing the credentials of Burnham here. And so from my point of view, particularly at a time when a lot of other investors are long and wrong in gilts, I think the market could be vulnerable to more of a correction. So I'd stay away from gilts at the moment and only be a buyer on more material weakness would be my idea. OK, and
a buyer on reassurance around the fiscal landscape and the naming of a chancellor that may be more bond market friendly, would that not be enough?
I'm not sure that's going to be enough. I think that we need to see what is actually done, not what is said. It's the substance over the style is going to be what matters. And I don't fundamentally believe that Burnham's going to be coming in here and doing nothing. So what is he going to be changing? We need to see the substance of that. are we going to see an agenda where some of the spending delivers growth? Because in the past, spending hasn't delivered growth. So it'll be a question whether Burnham can get markets on his side. And I want to wish a new Prime Minister well, but I just think we need to be cognizant of the fact that in the country, the taxation burden is already very high. We need to be aware of the fact that higher spending on benefits has not been doing anything to actually help growth. So can we get more of a pro-growth agenda? In that case, he may get more of a pass. But I guess my concern is that markets could well be in a situation where they don't want to extend too much trust to a new PM.
We're a few minutes away from French PMIs. They're going to be interesting. Did Legarde sound dovish to you today? Yesterday?
So I thought Legarde was a bit dovish, and from that point of view, I think this comes on the back of Philip Lane speaking just before, seeming to acknowledge that maybe 2.5 is the within the zone of where neutral rates are in the context of the Eurozone, and that may point to another rate hike to come. We're obviously at 2.25 at the moment. But I think that Lagarde's comments yesterday that no sort of additional severe sort of policy action was warranted, to me, very much is telling us we're not going to be getting back-to-back hikes. We won't see a hike at the July meeting. It'll be more a question when we come to the September meeting, whether inflation has peaked and is starting to move a bit lower, or whether at that time inflation pressures are still elevated and they want to go again.
From the ECB to the Fed, you were telling us in the break that the Fed arguably is the most dispersed set of views, and we're not going to get that forward guidance that we have been getting, and that's a change, and that makes it more challenging for the Fed. I mean, things could go either way. How much clarity do you have on the Fed's next steps at this point?
So when it comes to the Fed, I think the difference in the US economy compared to what we're seeing in Europe and elsewhere is we've got a strong economy. We've got inflation that's been above target for more than 5 years. You look at the economic data in the US, there's nothing to tell you that monetary policy is currently restrictive. I mean, look at the behaviour of stocks. It's very symptomatic, if anything, that monetary policy is relatively accommodative at the moment, not restrictive. So in many respects, it's very understandable that the narrative should be around tighter monetary policy being warranted. And if you took Walsh at his word and he really wanted to drive inflation back to 2%, back to the target, you could see how you might need to price in a series of rate hikes, maybe as much as 100 basis points over the course of the coming year. But on the other side of this, there is maybe this thought that actually Walsh is less worried about getting inflation to 2.0. Anything with a 2 handle will suffice. There's also this, he cares about the left of the decimal point, not the right of the decimal point. That's what he's told us. Furthermore, I'd also say that when you look at the inflation dynamics, if oil is coming down, inflation may be peaking. So if he's able to defer with his task forces for the next meeting by September, if inflation is starting to come down again, you could see how the Fed chair could actually use the excuse that inflation's now moving in the right way, and he could actually continue to sit on his hands and defer action. So it's making policy more uncertain. But the other thing that I'd say about this is it means that every meeting we go to now is effectively a live policy meeting. And so that's making things a little bit more exciting for us over the summer, I'd suggest.
Nice to see you, Mark. Thanks for stopping by to see us. We appreciate it. Got through a lot of ground there. Mark Dowding, Fixed Income CIO at RBC Blue Bay Asset Management. Let's take a quick look at the markets. I just want to show you ASML and just show you what is going on. First of all, give you an idea of what is happening with ASML and Schneider. As you can see, they are both under pressure. They're off their lows. Let's go to the individual stock story. Charlie.
I look at all of this red in the tech space here in Europe. So what we're seeing this morning really is that Asian tech sell-off spilling over into Europe. You can see some of the biggest names. Some of those names that have been linked to that AI trade in the red this morning. I'm looking at ASML. We've got BE Semi, Infineon as well, all in the red. So this really seems to be the dominant theme emerging here in Europe this morning, that Asian tech sell-off spilling over into Europe. Let's flip and take a look at something else that's been a little bit surprising this morning, the auto sector. I want to bring that up because we're actually seeing a lot of red here. Now, this is not necessarily expected, right? Because we just got those numbers out this morning showing that 4th consecutive month of growth in the European auto space, but we're not seeing that reflected here, right? Is this risk-off sentiment? Is this something else? Is this concern concerns about that consumer. Again, this is not what we would have expected going into this morning, but we're seeing a lot of red in the auto space. I want to turn and look at another really important European industry, luxury. Let's bring that up because, again, a lot of red here. Are we seeing risk-off sentiment across the board? I think that's the question to ask as this day continues. Hermes and L'Oreal, they both got downgraded from different houses this morning. There's been concerns about European luxury. There's a concern if this Iran war ends up wrapping up, which has really been hitting these brands, do we see more structural problems beneath? Do we see slowness from the Chinese consumer? Do we see inflation concerns hitting? So again, these downgrades really seeming to hit these luxury companies. Flipping to Selloff, because this is that French drug maker. They had a bad day yesterday. They hit a 6-year low. They're in the green this morning, so not necessarily expected, but they just announced they got approval from the EU for a multiple sclerosis drug. Is this that, or is this dip buying? That is the key question.
Charlie, thank you very much. Charlie Wells with a breakdown of some of those stocks on the move. Also on the move, the French macro story and a little bit of improvement at the edges on the services side, but still in contraction territory. So we've improved from 44 prior was the reading on French services to 47.4 now. That takes the composite up a bit as well from 44.9 to 47.6. So that is an improvement, but it's still below 50, still in contraction for services. The manufacturing story looks a little bit more robust in France.
Fragile. I think those are the numbers that are being used by Bloomberg Economics. This is a diffusion index. Yes, it's getting better, but it's still contracting. It's just contracting at a less fast rate. And that's the point here. The French economy is still under pressure. Services are under pressure. Takes us back to the ECB. What does the ECB do with this? Can it hike in this kind of environment?
Yeah, euro dollar currently 114, very modest move higher in the single currency. Not significant. 114 right now on euro dollar. Coming up, let's get back to the tech story because SpaceX falls for a third day, raising $600 billion in market value yesterday. We're going to discuss what is behind the descent. This is Bloomberg. Welcome back. So tech and the sell-off there is front and centre for us this morning. It's been a brutal day over in Asia with particularly the lens on the Kospi, which is down around 10%, and the read across then to European tech. And you're seeing the losses coming through then for the likes of ASML down close to 4%, Infineon dropping around 4% as well, ASM, ST Micro, all the big tech names in Europe taking a hit as a result of this turn in sentiment under pressure then. Let's bring in senior strategist Neil Campling for the take on what is driving this reversal. Doesn't seem like the dip buyers are back, and they're not in force, certainly. We've seen the ripple effects. Is this going to be sustained? What is? We haven't really pinned down what the catalyst is. Is it a multitude of factors, or is it one thing that stands out to you?
Overnight, since the US went home, I think there's one story, which is primarily coming out of local South Korean press. And it's talking about Hynix basically moving some of the focus of capacity to the more commodity end of DRAM memory as opposed to these high-valued, called HBM4 chips. So if Hynix is increasing capacity in commodity and taking capacity away from these super high-margin, super high-priced AI chips, the big question investors are saying is, why is that? Is there signs that the AI trade or the momentum side of things or the cost dynamics aren't quite as rosy as they were first predicted? So this, to pardon a pun, but is this the sort of a canary in the AI chip mine? That is a question investors are going to have, and I think it's why the Nasdaq futures have taken a significant leg lower this morning. So it could put even more pressure on Micron's numbers tomorrow night.
Is it a tech problem or is it just a market problem? What goes up must come down. We'll talk about SpaceX in a moment.
Yeah. Well, it is certainly these momentum factors. A lot of these momentum names and these baskets are up triple digits year to date. So we've had huge amounts of rises. Now, if you look at the Mag 7 stocks, they've become a funding trade for the semis and the AI on the other side of the AI trade. So it's kind of like the AI buyers who are these hyperscalers versus the AI sellers who are the chip companies selling to them, there is something going on within this dynamic. So it's something to watch for. When we've got token prices as well that have been coming down quite significantly from highs, when companies like AT&T and Uber have been telling their own employees to slow the spending on the tokens because costs are getting out of control.
Yeah, absolutely. So that pricing on tokens coming down, and that has an impact on those hyperscalers. And we've had Masayoshi-san, I know, talking about how he doesn't think that the answer is data centers in space, which maybe undermines some people's thinking around what SpaceX is valued. Let's talk about SpaceX, because they are that is a company that is now going to be issuing investment-grade bonds. This is for the first time. There's lots of other companies in this space doing it. It's a trend. Is that also potentially causing some volatility for stocks?
It certainly causes volatility around the hyper momentum in the sector. I think the big question, again, that investors will have around this particular instrument is why are they coming back to the market for debt and bonds when they've just raised all this money through equity? Why not do it all as part of the same package? It just shows that the spending is going to be significant and for many years, I think, for this particular ecosystem. And that's causing some concerns.
Yeah, let's see. Thank you very much, Steve, for stopping by. Neil Campling joining us on the tech story. Let's talk about the tank story. European tank maker KDNS is expected to announce its IPO possibly as soon as today. Could be one of the continent's biggest listings in years. It comes after France and Germany confirmed a joint governance framework under which both governments would hold equal stakes. I'm joined now by Charles Capel, Bloomberg European Equity Capital Markets editor. So getting over that kind of deal with France and Germany appears to have unlocked this. Are we good to go now?
Yeah, we are just waiting for the intention to float statement, and it is essentially a matter of time. The bankers, the advisors running the deal, they're going to be looking at the markets, they're going to be trying to find the ideal moment to do it. The thing that they do have sort of at the latter end is that the slowdown amongst investors, amongst bankers over the summer is sort of looming.
Yeah.
And IPOs are quite a long, burdensome process, and so you need enough time to complete that entire share sale process and the listing before everyone logs off for the summer and heads to the south of France.
What? That's a nice idea, isn't it?
Why do you need to go to the south of France? Is my question.
It's hot enough here. I'm going to Scotland.
This is the revival of the UK summer tourism story. That's quite the shift, isn't it, from tanks? Let's get back to the tanks.
Yes.
What is the valuation, Charles, that they're aiming for? How does that compare to peers? The structure is interesting, given the government ownership.
Yeah.
What is coming through in terms of what they're targeting?
It's really interesting. The number that's been mentioned a lot recently is around the 15 billion euro mark. Now, that's it's tricky because generally when you have an IPO, you offer it as a discount, and generally you want to offer a discount to their peer. Now, their main peer is Rheinmetall, which has been on a bit of a tear this year. But as I said, it's a moving target. And at the start of this year, we had a big rally in the European listed defence space. That's come off the top quite a lot now. And so when you look at, for example, CSG, who might be another peer, they listed right at the start of the year when European defence stocks were quite hot. They listed at 25 billion euro valuation. They're now trading at around 13.75 billion euros. So not quite what they were, and KDNS is going to have to factor that in. And we've seen that in some of the estimations around the value. At one point, we were looking at 25 billion euros for KDNS. Now it's more around the 15.
OK, Charles, thank you very much indeed. So that tells you a broader story about sentiment towards that sector, doesn't it, on KDNS? We'll watch that story throughout today as well. Charles Capel, Bloomberg's European Equity Capital Markets editor. Coming up, we discuss how AI is changing the banking landscape with Marco Argenti, Chief Information Officer at Goldman Sachs. Marco's with us around the desk. That conversation's coming up. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into the Tuesday session. Risk off across the equity markets. Then the handover from Asia has been rough. Currently across the benchmark, drops of 0.9%. Tech, basic resources, the miners are under pressure. The autos are under pressure. The selling is pretty broad. Right now, the DAX is down 1.3%. Amongst the biggest losses coming through for that index, then the CAC currently down 0.9% over in France. 0.7 is the drop here in the UK, 74 points. So that is the read across the markets. Again, the sell-off, the anxiety about tech, with the Kospi down around 10%. We have some economic data as well to factor in on the macro level. We have Germany PMIs coming through. We had the French numbers. Now we have Germany updating in terms of June composite PMI falling to 48. The forecast had been for 49.7. The improvements had been there for France. Services still in contraction for France. Manufacturing ticking up a little bit. But again, this is pointing to, as you said, Guy, fragility when it comes to the data out of Europe.
Yeah, so much for that German fiscal stimulus story driving an economic recovery. We're not seeing that. We're also not seeing a recovery as a result of what we are getting out of the Gulf. OK, let's turn our attention back to what we're seeing in terms of the European landscape. Tech is under pressure. Tech is under a lot of pressure. Index selling, we're certainly seeing that as well this morning. The ratio isn't particularly good. 123 up, 458 down. So you're looking at a 4-to-1 ratio on the downside. What is interesting as well is that the volume was big in Asia. So the selling was substantial in Asia in terms of the volume story. A little less here in Europe, but nevertheless something to keep an eye on as we work our way through the session, that AVAT function on your Bloomberg. Let's talk about the leaders. Food and beverage is doing relatively well today. Heineken's got a new CEO. That stock is up by 2%, but that whole space is kind of doing well today. Frontline is up as well. The shippers are doing better. Look at Roche this morning. I use it as being emblematic of a defensive bias in a market this morning. You're looking at healthcare doing well. Food and beverage is doing well. That's the picture on the upside, but there isn't much upside in Europe this morning. There's a lot of downside. Let's talk about ASML, the giant. It's by far and away the biggest points drop when we see what we've got here in Europe today. ASML is down by 4.4% right now, and really driving the point story down. The miners are also under pressure. Look at Glencore, down by nearly 4%. The car makers are also under pressure despite slightly better data out of Europe this morning. Stellantis is down by nearly 4%. So there's a lot of downside this morning out of the European equity space. Maybe not as much as we've seen out of Korea, but certainly some significant moves to the downside, Anna.
Yes, Guy, let's get up to date on some of the other stories we're covering then this morning. Oil has declined after the US issued Iran with a 60-day license allowing it to sell oil onto the international market. It's an economic lifeline for Tehran as the two sides continue talks on a permanent peace deal. Iran welcomed the waiver to allow energy sales after years of punitive sanctions. Apollo is once again limiting withdrawal requests from its largest non-traded private credit fund for retail investors. Apollo Debt Solutions, which has roughly $25 billion in assets, capped withdrawals at 5% of outstanding shares on Monday. The move came after investors asked to redeem nearly 17% of the fund. And Oracle reduced its workforce by 21,000 employees over the past 12 months. A bigger number than had previously been known. A regulatory filing reveals global headcount shrank to 141,000 full-time staff. And the company says the adoption and deployment of AI may continue to lead to job losses. Tom.
Well, meanwhile, global tech stocks, of course, as we've been discussing all morning, pulling back on growing concerns over the unprecedented AI infrastructure spending by US hyperscalers. This as companies continue to roll out AI that is changing, of course, how employees work. Goldman Sachs among them. Join us now, very pleased to say, is Marco Agenti, Chief Information Officer at Goldman Sachs. Marco, you've put out an essay on the Harvard Business Review talking about how to adjust and how to change around your job, how employees should be thinking about adopting AI, what it means for their work. We want to get your views on that, but I want to start with what's happening in terms of the broader sell-off today. Do you think, are you worried, does AI have a cost problem?
I think AI right now is at the stage in which obviously you need to weigh the cost versus the benefit that you're getting from it. In our case, we've seen definitely a clear impact, for example, on developer productivity, which happens to be one of the largest spends for most banks, but for us in particular, we have about 12,000 technical staff, over 45,000 employees total, and that's really where we started to see real advantage. So to me, the point is not too much about how much you spend in absolute terms. Of course, the number of tokens is growing, but at the same time, we're seeing productivity going up actually more than proportionally to the spend.
So you're spending more on tokens, you're not cutting back on tokens at Goldman?
We're definitely spending more on tokens than we were spending like a year ago, for example. But at the same time, we're also seeing way more productivity gains than we were seeing before. And so I think for us, the real question is not too much about how much you're spending with tokens, but what are you spending tokens for? Are you actually doing it for doing more productive work, or are you spending it to mostly do experimentation that might not yield to tangible results? And so the very first thing that we look at is, okay, what is the token spend by application, and are those applications actually translating into positive ROI? And that's really the calculation. One thing that I always think about when we talk about token spend is also the following. There is a sort, you might think you're saving money now if you're using, for example, a lesser model, but you might be accumulating technical debt, for example, by having code of lesser quality that you might have to fix in the future. So there is a net present value of essentially like your token investment, which needs to come into the equation. So it's not as simple as just looking at the money and the bill coming in. You really need to look at the long-term effect of your spend.
Do you think closed models or open models, open source models, will ultimately win? Like just in terms of the efficiency?
I think there is no tyranny of the or there, meaning that there is a place for both.
Okay.
And as you know, today, you're not just using one model when you do work. You're using what they call a swarm of agents. And so each agent is generally specialized on a specific task. And so generally what it's called the orchestrator, like the master model that decides which agent should do what, you generally want to have the maximum capability there, and you might want to use the latest frontier model. But then some of the other agents might do work, for example, I don't know, refactoring some code or putting a new design on 100 websites, etc., things that are more repetitive, which are well within the capability of models that might be slightly less capable, but definitely much more cost effective.
Coming back to the kind of the cost argument at the moment, it seems there's inflation rate within the chip space at the moment is epic. There's a limiting factor there. There's a limiting factor when it comes to electricity. What do you think the limiting factors are going to look like? Do you think we get past those limitations? Do you think we get to the point where costs can come down quite sharply, that we can... And do we need to go through that kind of, it gets very expensive and then it comes down again, for AI really to fulfill its purpose?
I honestly think they were still pretty early in terms of AI capabilities. Even if they look incredible today, if I just look at what they were a year ago and what they are today, so I think there is still a lot of space to be claimed by the frontier, for sure. And with regards to what is the biggest bottleneck. Definitely energy. I think it's what generally is perceived as the biggest bottleneck. But let's look at how token efficiency has evolved over time. And if you see like the latest chips, they are roughly like 10 to 50 times more efficient than the previous generation. And so the question is, is that going to go down faster than
the limitations
that you have? I have to say that this is kind of the moment of right sizing token spend. Like I would say, there is a lot of optimization that companies didn't do at the beginning. There is an old saying that's like, choose when to optimize. You don't want to optimize too early, but now it's time to optimize.
So what do you mean by that? What does that look like?
Look like that at the beginning, when you're launching something new, you want, for example, developers to be excited about changing their habits, like back to kind of what I wrote in the article. You kind of want to give them essentially like free choice of which models to use. Then when it comes to, you're now into processes that are more defined, you're now into a phase where you can afford to optimize and say, hey, for this particular job, let's actually use a different model, which might be less expensive. So you go from let's maximize the impact of AI and let's maximize adoption into more like, okay, let's now rationalize and optimize your spend. And that's generally... I've seen that, in the cloud, for example. There was a moment where cloud spend was a little bit, let's say, a little bit free for all. And then every company put guardrails in place to say, okay, we're using, particular services in the cloud that might be less expensive than others, or we're doing some stuff on premise. And so you get into an optimization phase. So we went from the sort of a maximization to optimization, and that's what we're living today.
And does that mean, good morning,
good morning
to you, Marco, does that mean that token prices fall then, if lots of companies are optimizing in the way that you described?
Let me give you. So the answer to that, I would say that probably the average token price is going to fall. I'm not sure if the frontier token price necessarily will fall, because at the end there will be more and more use cases that require the absolute best, but then at the same time there's going to be more expanding use cases that can actually do really, really well with other models that are less expensive. So I would say lower average, but I'm not sure about the peak.
Okay, interesting. And you mentioned that energy is the bottleneck. This is interesting because Masayoshi Son overnight was saying data centers in space, that's not the solution. Actually, we're going to solve this here on Earth. I mean, how are you thinking about this? What are the conversations that you're exposed to about where the energy need comes from? Because this is a sector that's going to require a lot, and a lot of people are investing a lot of money on the future being energy coming from space.
I think we're still at the very early stage of demand. I think the demand, if you look at the penetration of AI, every company right now is still in the introduction phase of AI. Developers are probably the use case that is more developed at the moment and more expanded at the moment. But then process optimization, companies are just getting started. And then you even like business growth type of use cases, like quant research or trading, or there is entire industries that are not touched by AI. For example, biology is just starting, material sciences is just starting, and so I'm seeing that the demand curve. If I can kind of judge from our own demand curve, that's actually not showing any signs of slowing down. And at that point, depending on where the efficiency of producing tokens versus the energy capacity are going to go, you might be in any of those scenarios. So I think at the moment it's very hard to predict whether there's going to be we're going to hit the energy wall or not. And if I judge from the actual consumption and everything that is not being realized yet, I think the answer is most likely yes.
Marco, can I take it back to the Goldman story and a comment you made at the top of the conversation about the ROI piece? To be clear, you are finding that ROI at Goldman through productivity, through efficiency, additional revenue streams. That is more than offsetting the cost.
It is, but not for every use case. Okay. So use cases that are mature, you can drive them towards positive ROI. That we have proved, for example, in the developer community, where we see. We said publicly that we see at least a 20% efficiency on a group of developers that is large enough for that to be very meaningful economically. Others that are more in the experimentation phase, they're not tuned enough. You might still not be in the ROI phase, but then you kind of follow a curve for which, with a mix of model optimization, with techniques like caching prompts, with, for example, right sizing the right model to the right use case, etc., you can definitely drive it towards positive ROI.
And a mindset shift amongst employees, it seems.
Yeah, absolutely. The mindset right now is, I think we went from fear to more about, the question is right now, how do I do my best work using AI? That's really the question that everybody is asking themselves.
Data. What goes in? How big a bottleneck is that? Are the data sets good enough? I imagine they probably are at GS, but
I love this question.
Yeah. Sorry, I left it to the end.
Please.
But that's got to be one of the critical factors here. I hear a lot of companies talking about the fact that their data is not good enough. It's not organized enough. It's not ready enough to be able to make this work properly or efficiently.
Data quality is really I think the most important factor that determines the quality and effectiveness of AI. There is no question about that. I have this saying, obviously garbage in, garbage out. Sure. Everybody knows that. But in this case, it's almost like garbage in and what comes out might actually not look like garbage, because with bad data, AI can make it plausible, and that's really even more dangerous. And so that's why one of the things that we've been investing on is a data platform that we call Legend, which is essentially like technically a lakehouse, but it's consolidating all our data needs into a place that makes it really easy for the AI to understand. And then before we instruct AIs, before they give us an answer, to really ground themselves onto data. So there is explicit instructions that say, before you say something, just show me the data. And the platform has an ability to create a lineage so that at every single step, you know where the data is coming from. And I think that was a fairly massive investment. And one of the things that I tell people when they ask me, okay, what is the first thing that I should do to get ready for AI? My answer is always like quality of data. The quality of data is really your groundwork, which will determine the success of your AI and ultimately the return on investment.
Okay, Marco, really fascinating insights. Thank you for joining us around the desk this morning.
Thank
Marco Agenti, Chief Information Officer at Goldman Sachs Group. Coming up, Andy Burnham, of course, looking set to be on the road to Downing Street. We're going to look at what that could mean then for the UK economy. That's coming up. This is Bloomberg.
This is the opening trade. Let's dwell on the UK politics story for a moment. Newly elected MP Andy Burnham appears set to become the UK's 7th Prime Minister in a decade. Still some process to go, but he is on that path to 10 Downing Street. The path was cleared on Monday when Keir Starmer announced his resignation as Labour Party leader. For more on the economic impacts of all of this, let's bring in Matt Bunny, who is from Bloomberg Economics and can give us his thinking on what happens next. Matt, we want to come to a question that we ask of lots of people, but we come at it from lots of different assets. So let's get the economist's take. What kind of room for manoeuvre does he have around these fiscal rules? Because he's committed to them, but then there's been a lot of chatter as to whether that's really settled.
So, I mean, committing to the fiscal rules was a sensible move, I think, given bond markets' nervousness about Burnham. But he is quite constrained. So he's also committed to Labour's manifesto commitments on tax, which eliminates any of the major revenue raises. So as a more left-leaning leader, we expect he'll want to lift spending. So how he does that will be challenging. I mean, the kind of key targets we've seen kind of discussed looks like land or wealth taxes. These are typically difficult to implement and also might not raise the revenue that they hope for. So the other path he may take is raising a loosening policy in the near term and tightening at the back end of the forecast period that the OBR targets. But any effort to loosen policy in the near term might be received with nervousness by markets.
Let's talk about how you get growth. Cut spending maybe, but that delivers a short-term hit. How do you get potential growth up in the UK? How do you lift that number?
It's the big problem that the UK has been trying to address for a long time. The thing economists would always typically point to is lifting investment spending. Doing that under the current restrictions will be quite challenging. The other thing that's worth noting is that typically the returns you see on this kind of spending take many years to materialise. And Burnham is going to want to have a win, obviously, in the near term as he makes his mark, presuming he becomes the next Prime Minister. I mean, there is hope out there that AI will save the day. Certainly there's great potential there, but it remains to be seen how much that will actually boost productivity in the UK, and in particular then how much that will flow through to government revenues. So there's a real tension there when it comes to the timelines for Andy Burnham.
Yep. If AI doesn't save the day, or if at least it takes some time, could the BOE save the day for Andy Burnham?
Well, I mean, obviously we've seen oil prices come off, and that's going to create some more space for the BOE not to hike rates. Our baseline call at this stage is for the BOE to remain on hold over the coming year. That will certainly be welcome news. Will it be enough to lift economic growth in the way that Burnham would like to see? Perhaps not.
OK, Matt Bunny, thank you very much indeed. Economist for Bloomberg Economics. And 10 years after the UK voted to leave the European Union, join us for a live Q&A hosted by Daybreak Europe anchor Lizzie Burden. Anyone can listen in, but digital subscribers and terminal clients have exclusive access to ask questions during the audio broadcast. That is at 2 p.m. London time.
Tech. Let's talk about tech. Tech's down, pretty much across the board. to varying degrees. That's what it looks like in Europe this morning. And it's actually reasonably ugly in some of the tech names that we've got here. But look at the bottom of that board. That is where Korea closed. That's a sell-off. Like, that's a kind of standard deviation, what is it, probably 2, maybe even 3 move that we are seeing in Korea, have seen in Korea today. Skylar Montgomery-Koenig joining us around the table. What do you think of that?
I mean, yeah, it's a very big sell-off. Maybe you need to put it in context of how big was the rally leading into that. So,
Yes.
you've certainly not undone the significant gains that we've seen so far this year. What I will say is it's a little bit more concerning the price action in terms of, yes, it's big, but also there's been less dip buyers. You're seeing people more
volume.
hesitant to come in. And I think, maybe it's more encouraging that there's not a specific reason for it. It seems more like it's just froth coming out of the market. What makes me more worried, though, is that we have a couple of event risks this week in the form of Micron earnings tomorrow, which, the markets had a very high bar for earnings to surprise to the upside for that to boost tech. And then you have PCE data later this week. And I think the worry is that yields are weighing on equity markets. I don't think we're quite at the point where in 2022 you had this worry around a massive Fed hiking cycle kind of popping the tech bubble, because we don't expect a huge number of hikes. But it's certainly more challenging from a valuation perspective.
Yeah. Is there something, to your point, I suppose, kind of picking up on it, is there something about this sell-off that doesn't make sense in that over in the US yesterday we saw a rotation out of hyperscalers into some of the chip makers because there's a concern that hyperscalers are passing on sort of, those profits to them in the shape of orders for chips. And then in the Asia session, we see chip makers under pressure. I mean, there have been reasons reported in the South Korean press, but there's something about that doesn't kind of fit together with the Nasdaq down another 2.4% right now in futures.
Yeah, and I mean, perhaps this is just, the big involvement in the market. Generally, you have retail, especially buying a big bit of the tech theme. And so you just see tech stocks and you get a little bit more worried about the frothiness in the market. And I think maybe my concern more broadly is that tech is so much of everything right now, right? You have a greater weight within credit markets because there's been so much IG issuance. Within EM is now a tech trade, essentially, right? If you look at the MSCI EM index, the biggest stock in it is Taiwan Semiconductors. That's 14% of that index versus NVIDIA being something like 6% in the MSCI World Index. The top 10 stocks in MSCI EM make up 40% of its weight. So as soon as you have tech going poorly, regardless of what the driver of that is, it creates this kind of broad sell-off that's very worrying.
And yet bonds are gaining, yields are down, oil prices are down, lower yields, that could provide some relief to tech maybe in the days ahead. That's not a dynamic we're seeing right now, obviously.
Yeah, I mean, I think the issue is there's a limit to how much yields can decline. Partly it's, are we going to get enough demand destruction from equity markets selling off to this extent in places that we don't look at as closely from a developed market perspective, in terms of maybe you need to see a lot of downside in U.S. markets, but perhaps that link is more broken than previously because of the inflation issues, because you have a more hawkish Fed. And I think this is very much the issue in that bonds aren't protecting you in the way that they used to. You have a bond equity correlation that's now positive. Yes, you get a rise on the day, but there's a floor because you have hawkish central banks, because you have inflation so high. So you need a lot of downside, I think, in the equity market for that feed through to be more positive.
Okay, Skylar, thank you very much. Bloomberg's Skylar Montgomery-Koenig with us with the latest on the markets. And we link it there on the US futures picture because it looks pretty negative. Nasdaq futures down by 2.4%. E-mini is down by 1.5%. So setting us up for a fairly negative baton exchange between Europe and the US.
Dollar's up. Is that the place to hide? Is that the story? You can see euro-dollar weakness this morning and maybe on the back of the PMIs, but is the dollar the place to hide?
Dollar index up almost 0.2% right now. So that is it, the opening trade. The Pulse is up next on a turbulent day for these equity markets. Stay with us. This is Bloomberg.